A history of scary moves. Where do you think the team's going with this one, Mr. Batista?
I have no idea. I really don't.
I mean,
Unless they're looking at like, the 5 to 10% moves. I don't know.
I mean, it is Thanksgiving themed, so but a history of scary moves. Let's take a look and see where the boys are going with this one. For new traders, large moves in an underlying can result in the stuff of short premium nightmares. Yeah, like a 50-point up move in the S&Ps today after being down 100 yesterday. That's not the stuff that I love. But experienced option traders know that it's unexpected moves that are really scary. To help us decide on strike placement, implied volatility times the square root of time until expiration gives us expected moves at any time scale. How reliable have the expected moves been, and does the answer depend on what time frame we look at? You want to tackle that?
Oof, it's a tough one here. I mean,
okay,
how reliable can expected moves be? I'm going to say 80. I'm going to say 75% of the time.
How reliable have expected moves been? I'm going to say very.
Yeah, sure, and 75 or higher. And how reliable? Go ahead.
Does the answer depend on what time frame we look at?
Sure.
And yeah, sure. I'm going to agree.
Yeah.
So I'm saying they're very reliable, and it does depend on the time frame. Mm-hmm. I think the shorter you go, the more accurate it is, and the longer you go, the less accurate it is. But the best way to take advantage of it is somewhere in between. That's like that 45-day thing. I think if you go out like a year or something, it's really hard to know what the expected move is. And if you're going out one day, that's reasonable. But, again, it's harder to profit from that. So we did a study using 20 years worth of data. We observed the realized SPY returns at the daily, weekly, monthly, and annual scales. Using the VIX derived expected moves for that time scale, we checked how many times the expected move realized the moves turned out to be. And we observed how frequently the realized move was at least 1 time, 2 times, or 3 times the expected move. In Black-Scholes Theoryland, these frequencies would be 32, 4.6, and 0.3. That's 1, 2, and 3 standard deviations. 1 times, 2 times, and 3 times would be 32, 4.6, and 0.3. So on the daily moves, and again, remember, you're comparing this 21.9 and 0.3 to 32, 4.6, and 0.3. So the realized moves and then the frequency of the expected move, obviously the daily moves, it's going to be way under because it has to be, okay? And that stays in line with everything we talk about in the show. Let's sell the daily premium and hopefully we keep the difference.
Sure.
So we go from daily moves to weekly moves. And in the weekly move world, the numbers are even, we would argue the numbers are even better. So you go from 32 to 17, from 4.6 to 1.6, and from 0.3 to 0.4. That doesn't really matter. But you're talking about, again, on a weekly basis, the realized moves are a fraction of whatever the expected move is supposed to be. Mm-hmm. So it fits the scenario that we talk about all the time. Let's go to the next slide. So now we look at monthly moves. And monthly moves are not that much different from the weekly moves, not that much different from the daily moves. And at 16, 1.5, and 0.4, daily, weekly, and monthly all make sense for the Tasty methodology. There's nothing scary about this. You're going to have outliers that bring everything into line, but that's the nature of the business.
Sure. Otherwise, there'd be no premium to sell.
Otherwise, there'd be no business. Yes. As soon as you get to annual moves, remember how I said before, when you go out to like an annual move, it's much harder. I can't predict something a year from now as well as I can predict something a week from now. When you go out to the annual moves, you can see that the difference between theoretical, which is 32, and actual, which is 30, is not that great. And the difference between 2 times the expected move, between 4.6 and 2.4, that's still okay. But you don't get a lot of like 2 times expected move. Like that's that's kind of the regulatory threshold. The real one is on the 1 time expected move because that's where we set up most of our trades. Like we're not doing our trades at five deltas and 3 deltas. We're doing our trades at 16 deltas, 20 deltas in that range. So one of the arguments for not going out to trade to short premium and leaps is you just don't have that much of an advantage.
Exactly, because volatility has so much time to change, so much premium built in.
The first one of these slides with the daily moves, you can see that the daily moves here, at least 1 time the expected, the daily moves are at 20 and 1.9 are less attractive than the weekly and monthly moves. So when you look here at the weekly moves, this is very attractive compared to the daily and the annual. And if you go to the monthly, which is the next one, which is how we calculate most of the things on Tasty, this is the best. And that's why we go out to 45 days, because it's just over that 1 month period. And this has the lowest frequency and the best numbers all around.
Right.
And this is where we live. Why would you do the yearly when the monthly is twice as good?
Seriously, I don't know. Like, why would you? Why would anyone?
Right.
I mean, if you see this.
No, I understand.
But you know what they think, I'm going further out. There's more premium to sell, that kind of thing. Why do it every month? Let me try to do the easier path. Sometimes the easier path is not the most economical, I guess.
Yeah. No, listen, I completely understand. I think that this is just an interesting discussion. And I think that it explains a lot. Let's go to the last slide, John, do the takeaways. All the daily and weekly levels, the VIX did a consistent job of overestimating market moves. Since the VIX is compiled from the 30-day option prices, it makes sense that looking at outlier monthly told a very clear story of 2008 and 2020. For all three, realized moves surpassed expected move far less frequently than Black-Scholes theoretical or so-called IV overestimate and overstatement. At the annual timeframes, the market clustered more closely around one expected move, only breaking 3 times the expected move during the beginning of 2008. So essentially, just arguing that the annual is just so much more difficult. This plays into why long-term leaps are unappealing for retail sellers, because they generate very little theta for their buying power, and the strikes at the expected move, lack significant implied volatility overstatement, only 30% instead of 32, and the other ones were down to 16. So it's just a study that says, hey, this is why we do what we do. In our world, we have to be less right to be successful.
Good job. Good job by you, Seth. I like the way you navigated your way through those slides.